and then
Let's Ali, we're gonna start over. Hey, how's it going?
good. How's it going?
So we're having a little bit of technical difficulties. So we're gonna redo some of the stuff we just did.
Yeah, I see we're live,
Zach,
so I
it's
think
so
we're
good
good.
to meet you, my friend. And I just want to go through that introduction real quick because you're so awesome. So Ali, Ali's over here. Let's show Ali real quick. Hi. Ali's our technology master over here, keeping us on the ball.
Yeah,
So now we are live with Zach. So Zach is a mortgage extraordinaire. He does a lot of work in the Toronto area, but also he serves all of Ontario, and his team serves all of Canada, which is fantastic. And he's also a avid investor, and he knows all about mortgages. And you have some ties in our neck of the woods in the Dufferin County area too, right?
yes, I got some family that lives out there. I personally live downtown Toronto, so I'm in the heat of the condo market down here. I just closed on a condo a few months ago myself as my owner-occupied place. And yeah, definitely work with a ton of investors in the investing space, constantly, growing people's portfolios, and that's my main focus there in terms of my mortgage business.
Awesome. So today's sit down and chat is going to be a lot of around the. Obviously, we're going to talk about current events. We're going to wrap that up real quick because this market's changing so quick. Then we're going to go into what this all means for the investors, whether you're new, you're an avid investor, you're trying to get into it, how you're going to grow your portfolio, what makes sense in this kind of market. And there's a lot of stuff that really makes sense for people that are investing right now. So we'll start with current events, and we sort of touched on this a second ago. We're going to touch on it again. When right after there's an announcement from Bank of Canada, it seems like right after they say, "Hey, there's another one coming up," and it usually starts low at 25 basis points. Then it goes to, "Oh yeah, it's going to be 50," and as we get closer, it gets higher. And like I was saying before, it seems like we're now they're saying 75 and likely going to be 100 basis points.
Yeah, like we've definitely been seeing the Bank of Canada be aggressive to try and combat that inflation. Luckily, those last inflation numbers that came out are a little bit lower. So clearly, yes, the aggressive rate increases are working, or hopefully they will continue to work. And it's a lot to do. Yeah, we're always kind of hopeful that rates won't go up that much, or at least the variable rates won't jump that much. But on the flip side of things, it clearly is good in a certain sense that if they raise aggressively and quickly, then we'll eventually come back down faster. Is how I kind of look at it. If you look at the positive spin on that, we'll hit that sort of peak of interest rates, which should plateau, should bring the inflation down, and then we can hopefully kind of get back to some more normalcy in terms of interest rates, not just continuing to go up by that 50, 75, 100 basis points jumps. And a lot of it too is you look at the states, right, as well. And that's when we had that first 100 basis point jump last month, right, was from the states going up 75 basis points. So they just did another 75 basis point hike. It's likely that we'll follow suit with a 0.5%, 75 basis point rise again, right?
You thinking, is this your prediction, 75?
I'm thinking it could be another 75. Another 1% is likely, but again,
I'm gonna go with 100 points. It sounds like I'm not gonna be surprised if that's what they do.
Yeah,
I look
at it as the good thing, right? If you want to be positive out there and say anyone with a variable or adjustable rate or a line of credit right now that's been going crazy, well, just hold on, weather the storm. You want these rate increases quickly instead of 25 or 50 basis points every single time that they meet for the next 2 years, right?
Exactly.
It could just be a slow burn instead of 6 months of aggressive rate hikes and then back to bringing it back down a bit.
That's right. And as an investor, and we'll get into this a little bit more. It affects you a little bit, but not as much because you're not paying your mortgage. Somebody's there's renters in your house, and we'll talk about how to maximize those things. So by the end of the year, what do you think and this is, I know it's a hard position to put you in. What do you think we're going to be at for mortgage rates? If somebody's on a variable mortgage rate, where do you think they're going to be?
Well, if we see another, 1.5%, it really depends on what the discount you got when you established your mortgage, right? Because I had a lot of clients that, a year ago or 8 months ago, even putting in prime minus 1.2, even some clients from way back, prime minus 1.3%. So even if the interest rates do get to the 5-6% range at prime, right, which is likely happening, right? Even if it's at 6%, you're at prime minus 1.3%. You're still in a pretty good position. Like, just don't move, weather out that storm. But we are seeing the discounts off of prime being offered now on mortgages kind of get smaller, right? We've seen prime minus 0.5% is sort of your uninsurable mortgage rate that you're going to get right now on a variable. Still good, right? You're at 4.2%, that range around 4%, or a little bit above. But we're definitely going to see 1.5%, say, increase before we potentially see a plateau, which means, we're going to see interest rates that are at the 5.5% range, 6% range. But that's sort of where the fixed rates are sitting now anyways, that 5.5% range. So not really uncommon. Still, people can handle it if they've been looking at this for some time.
Okay. And you're thinking by the beginning of next year, maybe we start to see a little bit of a curving down?
I don't think we'll see a curve down necessarily that quickly, but we'll hopefully see a plateau. We'll see, We won't see any more 1% rate increases, hopefully, right? Like, they can't, like 1%, then 1%, then 1%, like month over month. That's very aggressive, which I think would have a negative impact, but definitely a few large increases like we're seeing right now, and then a plateau for a while, depending on where those inflation levels go, is likely what we're going to see in 2023. And then maybe later on in 2023, 2024, we see those rates really kind of come back down to a median range, a pre-pandemic median range of 3%,
sure,
right?
Yeah. And again, none of this matters very much at all if you're investing. And it actually might even be good news for people that are investing. So these rate hikes might be a good thing for you if you're an investor. So
definitely in terms of purchase price, for sure.
Exactly. So we'll get into that. So first, let's talk about your portfolio as an investor. You have a couple of investment properties. What do you have? Tell us about it.
So I personally only have a couple, but then they're joint ventures with people, right?
Cool.
So I have my own personal owner occupied, which I had one and then just changed and bought a condo, which I don't advise is actually a good investment. I like being in downtown Toronto. I like, buying in Toronto, great investment, I'd say, because it's a great market that really fluctuates, I'd say, the least when there's downturns in the market. But in terms of buying and an investment wise, it's much better or more lucrative for people to go out there and buy, a multifamily or live in one unit and rent out the others, like house hack type thing, if you're really wanting to get into that investor state or actually have cash flow. Especially buying condos as an investment, I think, is a poor option as well. I do have a cottage that I own with a few people that we do as Airbnb.
Cool.
Income as well. And I'm looking right now to add, especially probably in the next 6 months or so, looking into my first kind of project of a multifamily, like turning a duplex into a triplex type deal, or looking for some sort of project out there where I can add some value with some renovations into it and then turn it into a cash flow.
And we'll get deeper into that. We'll get deeper into those.
Yeah.
But let's start with just somebody getting into this kind of stuff and just thinking about with the slides we have up on here. And let's look at cash flow. So let's say I'm wanting to get into the market. I have about say $300,000 in equity, and I want to pull that out of my house. I want to buy another investment property. And I'm looking at a house that's about $700,000. So because we're looking at cash flow right now, and that's likely the most important thing for somebody trying to get into this kind of thing, right? So what would my mortgage be looking at a $700,000 house? Actually, let's start with this. How much do we need to put down for a $700,000 house if I'm an investor and I have decent credit?
So a minimum down payment on an investment property is 20% down.
Perfect.
Right on that. That's your bare minimum. Now there are, as I said, to get into kind of options though, just to throw them out there, buying an owner occupied with a rental suite in there, depending on the purchase.
We'll get there. Hold the thought. Hold the thought. Okay. So we got $700,000 is the purchase price, but I have $300,000. So I, as an investor, could maybe even go and buy 2 properties, because 20% of 700 is 140 grand, and I have a little money to spare. So I could technically go out and look at a $700,000 property. And then thinking cash flow right now, we'll get into some other things in this as well. In terms of cash flow, what am I looking at? So let's talk about let's say we're just getting 1 unit, and we'll go into multi units a little bit later. But let's say at the 700, I put down 20%. What's my mortgage going to be?
So one, you're obviously depending on going fixed or variable or adjustable rates. I always say for investors, it's better to be in an adjustable rate scenario, because it's easier they're going to have less penalty to break to get out of them, easier to refinance, pull money out of it. You just don't know as an investor. You want to be able to have that flexibility. Locking in a 5-year fixed rate might not necessarily be the best option for you. But if you're looking at, say, a $700,000 investment property with 20% down, you're looking at $2,800 or so a month, probably right now at a 4.5% interest rate, somewhere around there. Okay. Plus, it's $700,000 if you're going a condo fee, property taxes. You need to put all of these things into play to calculate your cash.
Let's take condos out of the equation.
Okay.
Right. Our neck of the woods, you can buy a decent house for that price, $700,000. You can buy a decent house. Rents range from $2,800 to $3,000. Mm-hmm. That's positive cash flow.
Yeah, there are a lot more factors. The simple way to look at it would be cover the mortgage payment. Yes, that's sort of ideal. You do want to, as an investor, look at potential vacancy rates, and if it's a house, repairs and maintenance, and take all those things to be very realistic on your month over month cash flow, what it's really going to be. It's best to be more conservative. But a thing about cash flow too, especially right now with the interest rates being higher, if you can stomach some cash flow, negative cash flow even, but the investment, the property is good, it's going to be a good property that builds in equity, right? That appreciates well in an area. All those sorts of other factors need to be taken into account, because if you can stomach that $200-$300 negative cash flow, you can still be in a really good position.
That's great.
Investor.
That's right. And let's break that down a little bit more for the folks that don't speak our jargon. So let's say they have that, say, $2,800 mortgage per month, and they're charging $3,000 a month, right? Mm-hmm. Out of that mortgage that they're paying, how much of it is actually interest? How much of that is going into their bank? How much of that money are they banking and paying down that principal?
So again, depending on the interest rate, but if you're looking at that 4.5, you're probably looking at $800 to $900 is going to principal, and the rest to interest on a 30-year amortization too. So it depends. That's where we're going to 30-year, right? So the length of the mortgage is 30 years, where the term that you're actually going into would be 5.
Sure.
$900 would be going to principal. So I always say that to people when they're doing these calculations. You got to think that $800 or $900 is going back in your pocket. So the real cost of carrying that property would be the interest payment on there. That's definitely covered by the rental income that you have coming in.
But here's the thing: it's not their money. And but the $900 is $900 you didn't have before, that you're getting monthly into your account. Now duplicate it again and again and again and again and again, right? How much money do you have? And then let's take that one property, let's break it down a little bit, like we were talking about before. Maybe take a bungalow, which is kind of what I do. I take one property and I split it into 2. From one, you get something around $2,800. From the second one, you get about $1,500. Now you're way in the positive, right? You can put away money for your next property. You can pay down the mortgage if you want to, but then why not, just go get more properties, right? But this is money. And I think what a lot of people get bogged down on is that, oh my God, that's a big number. That's $2,100 gone, right? I'm not making any money. But where they forget that they forget that this is a long-term investment versus a short-term. When you get a rental property, it's not going to be, I'm going to flip a switch, I'm going to make some money. It's going to be a 10, 20, 30-year game where a lot of folks are thinking like, well, in 5 years, I'm going to cash in on this one.
I always think when I sit down with someone who's even has questions about this, look at their long-term goals and their long-term trajectory and what they're going to do, what it's going to look like to hold a property. Even if we do a lower average appreciation of 5% a year, let's take a look at that. If you hold it for 10, 15, 20, 25 years, like you were just saying, what can we look at after 5 years? Not selling the property, but extracting some equity and buying a second rental property, or upgrading your owner occupied, or doing whatever you kind of want with that money. So I always think long-term strategy. Flipping properties, much different. I wouldn't even really call it, I guess it's a form of real estate investing, but I wouldn't really call it investing in the sense that you are planning on holding this property for 5, 10, 15, 20 years, right?
You're speculating. That's a speculation. So versus where this is a lot more of a safe option. So it's a long game. It's not for everybody. So we know that now. Let's establish it. So if you're thinking about, short-term gains, it's not going to be there for you. So don't watch this video anymore. Go away. So if you wanna have that long-term game, and you wanna have something for your retirement for your kids down the road, you want to have millions of dollars of old money set away, this is what it's going to be. Yeah. So
one line, speaking of kids there, sorry to cut you off. I always say, do you want to buy, if they have young kids, do you want to buy them a house at 2022 prices, or do you want to buy them a house at 2042? Because I guarantee it's going to go up. If you ask your parents 20, 30 years ago, like if they bought two houses right beside each other, would they have done it, right? Like, of course, everyone's going to say, yes, of course I've done it. I'd be a multi-millionaire if I owned two houses on the same street as opposed to just the one that I bought 30 years ago, right? Yeah. So that's a big, always a statement that I throw out there. It's like, why not, if you have the ability to buy something now, and you're probably going to help your kids or have to help your kids buy something in 10, 15, 20 years. We're seeing it now, where I pretty much on every file of a younger individual or a younger married couple, we have mom, dad, or grandparents or a co-signer on there anyway. So if you're going to help your kids when it comes time, or a gift from them, why not kind of get into it now, jump ahead of the game, and then build generational wealth for their kids as well.
100%. So this video is for you guys if you want to build generational wealth. Yeah. So and also just to take the most recent numbers a little bit into perspective. So if you take all of that speculative froth of like the FOMO people had and take that and just throw it out the door, real estate doesn't go down in price. There was no homes for sale back in, a few months ago. So people are fighting over a scarce resource. So now that there's some stuff available, you see that froth go away, but there's going to be a place where we've actually made a lot of gains since the pandemic, a ton of gains. So real estate, even if you just buy dirt, even if you just buy land, it's going to be a hedge against inflation, where it's so different from stocks, where you can just be like, buy, sell, buy, sell. This is going to be something where you just buy it and you just hold on to it.
But you even see, in relation to stocks like that, you even see the real people that win investing in stocks have a long-term buy and hold strategy for 20 years, right? Like the real people that have slow, safe gains, put money in, and continuously and hold for 20 years. It's the same as real estate. You're going to maybe buy and sell quickly and do a flip and do something might work out for you. You might win, you might lose, right? It's a lot more risk involved. It's the same as like, buying and shorting or quick selling stocks as well. The long-term hold strategy is safe and almost guaranteed, right?
100%. Who says that? Somebody says that. Who's that? Is that the long term gain on that.
Sounds like Warren Buffett.
It is. Nice.
No, I didn't say his particular quote, but the strategy for sure is
along those lines. So let's get into other stuff. So buying real estate is also beneficial and in terms of investment, because it protects your wealth as you go forward, because nobody can touch it. Plus, any money that you gain from it, obviously it's a income, but it's there's a lot of tax breaks there too, right? So that maybe you can share a little bit about that.
So one big strategy that investors will do a lot of the time is pay off their principal residence, their owner occupied, as quickly as that's the only mortgage they'll kind of want to get rid of or keep the most minimal, right? Because the mortgages that they have on rental properties, all the interest from that mortgage is you write it off against your income, right? So if you're paying $2,000 in interest over one or two investment properties a month, that $2,000 a month can be written off against your income. The interest that's on your owner occupied property, it cannot be. So a lot of the times when you start to build that portfolio, you can go and actually refinance, take money out of your investment property, increase the mortgage there, and pay off your principal residence down as quickly as possible, because you can still write off that interest on the investment properties, right?
And
so that's
sorry to interrupt. There's my 2 cents, and there's also, if you improve that property, so say if you change it into 2 units, you fix the roof, you fix the driveway, you make it look nicer, that's all back into your investment, and that's money you don't have to pay tax on.
Yes, exactly. And when you do a refinance or remove that equity from the property, turn it into cash, that's not taxable. That's because technically it's a debt. You've incurred more debt, even though now you have $100,000-$200,000 cash that you can deploy into another investment or pay off your principal residence. That is not taxable income until you sell that property. You're not realizing those capital gains, right? At that point, you will pay the tax on the capital gains. But if you don't sell, you don't have them, you're just pull money out like a little endless piggy bank from your investment properties, right? And continuously refinance, extend the amortization back to 30 years to lower the payments. Like, that's the strategy that I'm consistently doing in my investor clients that own 3, 4, 5 properties. They're always their objective isn't to pay that mortgage off as quickly as possible at all. It's like using it. They want to keep the mortgage on it. They have the tax break from the interest. They can pull up money out with the refinance. They can keep pushing it back to 30 years, or, even with B products that go to 35 or 40-year amortization, that's getting a little bit more crazy, which we may get another video with that stuff. But they want to extend it as much as possible to make those monthly payments as small as possible, even if there's more interest, so that the cash flow is better as well, right? If they can lower that monthly payment down from, say, our initial example of $2,800, it goes down to $25. Now we have another $300 cash flow that can cover those incidentals or expenses or anything else that might happen with the property. Right?
So this goes back to the point of, this is a long-term investment. And now let's look at that. So we've got some tax write-offs, and we'll likely have somebody here that can help us with that. We'll have we'll bring on some financial advisors that can help us with that as well.
The accountant will be able to help you with those.
Disclaimer: we're not financial advisors.
Yeah.
So, but we can give you some advice, but you got to see a professional. Now the community impact is pretty awesome too. There's a sort of a stipulation of that if you own properties, you're a landlord, you're terrible, you make all this money, but it's not like that. I actually make friends with my tenants, and they might be late here and there, and that's okay. And they're very nice people. They've helped me out when I needed it, and they're real people. And what we've done is we've helped these folks be able to get more affordable housing, right? And be able to kind of realize some of their dreams. Obviously, they're going to have a family in the house, and they're going to be able to get a roof over their head. So I think this is pretty important, and reinvesting into that property and making improving the property, making their lives, it makes their lives better. And obviously they're thankful to you, and you're not kind of, just getting a house, just kind of letting it do its thing and kind of go to the wayside, right?
Yeah, and something you touched upon earlier, say buying a bungalow and adding a second unit, or making, putting an addition onto something, making it into a triplex, things like that. You're actually taking those properties that may have been bought and sold in a single family residence into a multifamily, and increasing the rental units in the area, right? Increasing the amount of housing.
All right, that's right, and so it's a good thing, and you can actually get involved with your community and help them out, and you get into these people's lives and you get connected to them. So there's a very awesome part to this as well, very human part to explore as well. So if you guys ever have any questions about all the awesome stuff that comes along with this gig, give us a shout. We'd love to help you. Now let's look into some stuff that's not so great, where you have to get your mind around it so you can be a really good landlord. So obviously there's going to be a fair bit of money up front. If you're smart and you have some money in your equity, you can take that out and use it. Maybe you're just a first-time investor. Maybe you're living with your parents and you want to buy an investment property. So it does take a fair chunk of money these days to buy that property. Now, when we're talking about some good sides of this of the rising interest rates, is that it is definitely making there's definitely a push down on prices. There's definitely a reduction. Now, what we can do is we can actually go, as on the real estate side, we can actually go make a future-proof offer to somebody where it might already be 5 to 10% less than what they're asking. So then if there is a 5 to 10% reduction down the road, it doesn't matter to you. And obviously, as long as you have that cash flow, you're good. So there is that, big chunk of money you got to put in.
Yeah. I know we're talking about risks here, but I kind of mentioned it as well. Yes, there's a big chunk of money you have to do to buy an investment property. Sorry, excuse me. But if you do find a property with that legal, basement unit, already conforming basement unit that you can rent out, or, something that's a duplex or a triplex that you can buy that's under $1 million as an owner occupied property, you can get use programs to put a minimum down payment on that. And I know we were talking just about 20% down in our initial conversation around an investment property, but there are options for you to put less than 20% if it's an owner occupied property and rent out those other units. So that's a little, I know I'm playing devil's advocate to be a devil's advocate here.
For sure. And that's what we're here for.
Ways to maybe not have to put up as much money up front, but it is a big chunk if you're putting a straight investment property and 20% down, but there also are some ways that you can kind of get around that too.
And I would say it's probably a good idea to have a little bit of a slush fund, because this is not, and this is the second point, it's not a sort of a liquid asset like stocks where you can go in 15 minutes and grab your money. Yeah. It's going to take, if you want to sell it because you're strapped for cash, then you're in trouble, especially in a market like this.
It will take you a while. Yes. Like I was just going to say, especially in a market like this where it may take 30, 45 days, whatever, to actually sell the property.
Yes.
What I do as well, this is a good little point. I like how you made this risks, because I'm going to have the counterpoints too to mitigate the risks as well, is anyone that has an owner occupied property already and they're buying their first investment, and I'm sitting down with them going over it, I always try and see, okay, is there room to maybe take out some equity, or you have the savings already and you want to buy the property, but can we open a home equity line of credit on your owner occupied property right now for $50K, $100K? Let's tack that on. It's no cost to you in terms of interest or anything you're paying. You're just going to have that available if there is something that happens to the property, if it's untenanted for, it's not going to happen in this rental market, but say there's 1 or 2 months where you don't find a tenant, something like that, where you have to carry the property or the full mortgage. If you have that home equity line sitting there, you can draw from it if you need to. You can pay it back when you want. It's not like you're just straight paying the interest on it right away. And for most people, if they're coming up for renewal on their mortgage, or if they're refinancing to buy an investment property, I say, let's look at that option. Why not? Let's just tack it on there to give you that safety net, so you have that liquidity,
yes,
if in case you need it, right?
So if this is your last bit of money, I wouldn't suggest you put it all into the house,
Yeah,
right?
yeah,
You need
exactly.
to have a little bit of money put away for incidentals and things that will happen to the house. So we'll get into that the next part. So not only is there's some time commitment. So there's a money commitment. There's going to be some time commitment to this as well. There's going to be times where you need to go to the property to do things, or find somebody to come and repair a bathroom, or the fridge might break and people can't live without a fridge, so you got to get them a fridge. So you can't just leave that to the tenant. So there needs to be that. There's obviously going to be some money that needs to be put away for incidentals. I'd say good at least $20,000-$30,000, just in case.
Yeah.
So if you're strapped and you don't have that, I would say maybe wait until you have that, or try to get it from your equity. And then second, there's that time commitment where you have to start to, obviously you want to have a good agent that takes care of getting the right tenants for you. But once you have the right tenants, just even going back, getting the right tenants, you might be, leaving that house empty for 2-3 months. You're gonna have to be able to cover that mortgage. And we usually go through, unfortunately, about 20 people before we find and especially in this market, it's crazy right now for tenants to find the right people. You got to make sure, and you can't just give the house to anybody. You got to make sure you go through the right process. You do the credit check, you do the background check, and you make sure you're letting in the right folks, and you give them the right folks the key to your house, because it could end up in a disaster. And I personally have been in that situation where somebody, was in my house for 3 months and I couldn't get them out, and they skipped out with $6,000, and they left the house a big pile of mess. That's for sure.
That's definitely, yes. You want to make sure you have the right tenant in there. It'll be easier or more difficult depending, I think, on the area that you're in too, depending on, the income levels in the area, the demographics. But as you said, and as we know, that the rental market's crazy. So you really do have the pick of the litter here, where you can do all that, do as much due diligence as possible beforehand, and mitigate that risk as well.
Right? So I would say right now is sort of the perfect storm for somebody that wants to get into the investment market. So look at this slide. This is sort of a Canada snapshot. So it's sort of everywhere. There's obviously homes out there in Alberta for $300,000, $200,000. But around here, I think average is still about $1 million. So there is opportunities out there to get a home that's decent. It's going to be a good investment for anywhere around 650 to 700, maybe 800,000, depending on what you can afford. So obviously there's a downwards pressure on the prices, right? With all these increases, so that's a good thing for investors, right? And there's an upwards pressure on how much you can charge for rent, because rent is high.
And if you're an investor, especially more experienced investor, have been doing it for longer, you're not just looking at, like we kind of touched upon, positive, negative cash flow, sure, but the interest rates that are cyclical. We know they're up right now, but they'll come back down. So if we kind of think, we have the ability to have negative cash flow for 12, 18 months while the rates are up, and we know we can refinance down the line, but the rents are still going to be there. We might sign a 1-2 year lease, find good tenants that want to live there for a long time. That rent's still going to be there. Those overall costs will come down, and you're getting the property for cheaper than you were 4 months ago, 5 months ago in February and March when we were at the peak. So now your starting mortgage amount and your purchase price, you can't change that, but the interest rate will change over time. The costs of carrying that property will change, right? But that starting amount is where we're seeing it lower, and I'm seeing crazy amounts of activity for investors looking for deals and trying to find something that's been sitting for a while in the market.
100%. Ali's signaling me that we're going over time, but I wanted to talk to you about one last thing. Investing abroad from outside of Ontario, say, you'd be able to help folks with that, obviously. And what are you hearing right now? Where's a good place to spend money? I got my people in my ear. What do you hear?
I hear more and more about Alberta and Cal, like you mentioned there, just because it's cheap and easy to still get in the market. It's not like you have to have $140,000 to buy a $700,000 investment property. You can have $60K and go and go find something, right? And then potentially buy multiple because the cash flow is very high. You got to also think as an investor, though, is it worth it in terms of the areas and how they've been appreciating in the past? And is the appreciation going to continue at a slower pace? Because if you're starting at a property that's $250,000 and it increases by 5%, it goes up $12K over the year. Or do you want to buy a $700,000 property when it appreciates? You're seeing $30,000, $40,000 a year in appreciation, right? So, but it's obviously harder to qualify for those mortgages because they're bigger. You need the higher down payment. The risks are higher because there's more money involved. Like it's easier to carry a $1,200, $1,400 a month mortgage payment if you don't have a tenant in there, as opposed to a $25,000, $3,000 mortgage payment if you don't have a tenant in there, right?
So you're a new investor and you're living with your parents. You got 60 grand laying around. You want to buy an investment property. You can get your feet wet in Alberta.
Potentially, but then I would say I like Ontario just because that's where we live, and I think there's so many markets that are discredited that are Northern Ontario. Look to Sudbury, look to Bay, look to like farther out west, past Hamilton, everything like that. You can still go find for $300,000 to $500,000 investment properties that can cash flow as well, right? So that's also options that people don't think about, those tertiary, secondary markets in Ontario itself.
Or the Airbnbs. How's that working out?
Yeah, or like if you go in with people and buy like a cottage, rent.
Yeah, how's that? Is that I want to ask you about that. How's that working? Is it good?
Very good. So it's been a recent purchase as well, but looking into, again, that actually brings up a further point. One, yes, that's a great option to do so. And if it's a cottage, you can go ahead and take it for a week or two out of the summer or longer than that and enjoy it yourself. There's a lifestyle aspect to it as well. But if you don't have enough personally cash, maybe you have $60K and you can qualify for a $300,000 mortgage. And so does your good buddy from high school that wants to get into it. Well, there you go. Now you got a $120,000 down payment. You can go buy something for $600,000, right? Or $700,000. So like joint venture partnerships there, because that one, you're sharing the reward and you're sharing the risk too.
Exactly. So, and you obviously want to have really well laid out contracts, which will be another
100%. Yeah, like a whole team in place. Yeah. I don't think we touched enough upon that, but for next time, we'll talk about the
I could talk to you for hours. I know that once we post this, lots of people are going to have questions.
Yeah.
And where can they find you? And we're obviously going to post this information on this video. We're going to have it on Instagram. We're going to have all his info everywhere if you want to get in touch with them. But let us know, where can they reach you?
Instagram, Mortgages with Zac. You can hit me up there. info@mortgageswithzac.ca. Email, call me, text me, 416-275-3649 all day. I'll talk to you for 45 minutes about investing as well. No problem.
Awesome. Thanks, brother. Thanks for being on this call with us. We really appreciate it. We'll hopefully see you really soon, and we can get people into investing a little bit more.
Okay. Awesome.
Right.
See you later.
Bye.